Boom! We are live. Welcome back. I just recorded a Silicon Valley Bank rundown. It's a longer video, so I'm going to try and make this video a shorter video that's about action items, things that we can do in this market. So there's uncertainty with the banks. There's things going on. If you want to understand more, watch the video. It's 30 minutes. You'll have to listen to my annoying voice the whole time. But real quick disclaimer, I'm not a financial advisor. I'm a dude on the internet with a bird over his head. So take everything I say with a grain of salt, and please do your own research and understand what you're doing. Um, so I just want to give some of the things that I'm thinking of right now, some action items, things we can do in this type of market. Um, so the first and the most obvious thing is this is personal finance 101. Increase your income, decrease how much you spend. Watch out on debt. Don't have any variable rates, anything like that. That's bonehead basic stuff. I'm not going to go too much into that. That's something we should always do, is try and earn more, spend less. Don't um, don't increase your lifestyle. Now's the time to start minimizing your lifestyle, because the larger your lifestyle gets, the more spend you have. So that's all I'm going to say on that. Um, and the other thing I want to say with the banks is, there's uncertainty, there's bank runs, funds are getting locked up. If you have more than 250,000 in an account, um, it may be wise and maybe a pain in the butt, but 250 grand is what is FDIC insured. So it may be worth it to open multiple accounts at multiple banks and keep the max of 250,000 in each account. Because if one bank goes under and you got $1 million in there, they may just give you 250,000 bucks. So if you're a high net individual, you probably got someone managing your stuff, and you shouldn't be listening to some dude on the internet anyways. So the other thing I want to mention quickly is I think it's important to get yourself into a position of power. When I say that, I mean be ready to seize opportunities. And right now I have a chart up of the VIX. The VIX is the volatility. When the VIX goes up, the S&P 500 goes down. So the general stock market goes down. And this is my stupid chart that I have with stupid lines. But I have on here a note to myself. When the VIX is high, it's time to buy. When the VIX is low, it's time to go. That's two, you know, my 2 cents on the VIX. When the VIX is high, there's volatility, there's panic, and there's opportunity there to buy assets that people are liquidating because there's uncertainty. Now, I'm not saying go buy everything in the sun. It's very important to know what you own in these situations. I personally like certain ETFs, but you have to do homework on understanding what's in those ETFs. I like to explain to people, if you really like Doritos, buy Doritos. But um, some people like to buy the variety box of chips where you get the Funyuns, you get the Ruffles or whatever. But if you don't like Funyuns, you're going to have to get Funyuns in that pack. So if you go buy an index fund or the S&P or the Dow or the NASDAQ to get exposure to certain stocks, just go buy those certain stocks if you really like those. Now you're taking a risk that those stocks go down and you have to bite the bullet there. Just like you're taking the risk if you buy one big bag of Doritos and all the chips are stale, that whole bag is worthless. So single stock risk, there's a lot of risk there, but there's a lot of reward if you're doing the research. So be in position of power, know what you own, and know why you're buying something if the price falls in half. You could have went and bought Silicon Valley Bank when it dropped 60% the other day, for it to drop another 60% the next day. So know why things are dropping and know the fundamental story for those assets. Um, so if you're going to buy stocks, I highly recommend, I talked about this in the other video, buy companies that are cash flow positive and don't buy these high flyer stocks that are losing money, because money is no longer free. When we look at interest rates have gone up drastically. So the cost to borrow money is a lot more. Here's the 10-year yield. So interest rates went from basically 0 to 4% on the 10-year. So the price to borrow money is a lot higher. So you don't want a company that's losing money and needs to borrow money all the time, or they're gonna dilute you, share count wise. So be in a position of power. If you have a lot of cash, it's a great opportunity to get yield on that cash, and I would recommend purchasing bonds from the government. I would be very careful on buying corporate bonds right now, because you're taking a risk on the company defaulting. If you buy U.S. Treasuries, you're taking a risk that the U.S. government's going to default, which if that happens, you're going to have a lot more problems than worrying about your bonds. So if that money that you buy with bonds, that is locked up. So you cannot take that money out to go buy Apple stock if Apple stock gets cut in half. So be aware of that. But I think that is a great place to park some money. But I think it's also a good idea just to hold on to cash in an account somewhere and be ready to go buy assets as they start to fall. And right now is a great time to get out a pad and paper and start doing research. What do I want to buy Apple at? Where do I want to buy, whatever commodity or whatever you want, whatever it is that you like. Start doing some research and figuring out what is a fair value for this stock, how much are they making, what are their earnings, how much debt do they have, what are their exposures, all those things. Start doing some research and getting ready is my opinion. And I would say keep an eye out start looking at real estate, seeing what's out there. Basically, my whole point in this video is that it's looking like there's going to be more volatility in the market, and there could be a lot of forced liquidations. So when there's forced liquidations, there's opportunities for those people that are ready. It's unfortunate that we are in this situation, but there are opportunities that are going to come out of this if you have your eyes open and your ears open and you're in a position of power. So again, I think it's important to build up a war chest, a liquid war chest, and understand what it is that you want to buy when the shoe drops. The other opportunity I believe that is out there is in the TLT. And again, I'm not a financial advisor. This is not financial advice. Do your own research. But the TLT is inverse to interest rates. So when interest rates go up, the TLT plummets, like we see on the chart. When interest rates go down, the TLT goes up. The reason for that is the TLT is bullish on people buying bonds, and when people buy bonds, the yield goes down. The reason the yield goes down is because more people are purchasing it, so the yield is less. If you have a lower quality company or country, the yield on their bonds are a lot higher than a high quality company or country. The reason is it needs a high yield to entice people to take on the risk of buying their bonds. So the Fed has to deal with inflation, and that's why we're seeing interest rates go up as much as they have, is because we have a hot economy and the Fed can reduce liquidity by raising interest rates and also not buying assets. So you can see again on this chart, rates have kind of hit a little pop here. And again, ignore all these lines. But as we're seeing things in the economy start to break, possibly because of the increase of interest rates, we may see them start to hold off a little bit. Now, I'm not saying they're never going to raise again. They're going to raise on March 22nd, and they're probably going to raise a couple more times. But I think we're much closer to the end of them raising than we are at the beginning or the middle. I don't think we're going to see 7, 6, 8, 9%. And so because of that, I think there's an opportunity to start building a position in the TLT because it's gone down so much, and you can see the trend from the 2000s is going up. And again, it's inverse to interest rates. The trend on interest rates have been going down for the longest time. We are breaking that trend here, and things in the economy are literally breaking. Banks are blowing up. So that's the pickle that the Fed is in. And I have the opinion that we're getting, again, closer to the end than we are at the beginning. Another vehicle that you can trade is the TMF. The TMF is similar to the TLT, but it is levered. So there's a lot more risk here, but there's more upside if you feel that this is a legitimate play. So do some research on the difference between bond prices and yields, and that'll make the TLT. Once you understand those, you'll understand the TLT a lot more. Um, so other than that, keep an eye out, have cash ready, know where your money's at, know the liquidity, know the backstops for your banks, um, and just be prepared. Keep an eye out. There's going to be a lot of fear, a lot of uncertainty, um, and we should be paying attention and we should be worried. I don't want to get into the bailouts and all that stuff, but just think glass half full and look to take advantage of these opportunities because the system's gonna keep going on. The system's not gonna blow up and burn down. And if it does, you better have canned food and a spear and be ready for whatever happens. So that's all I'm gonna say on that. I hope everyone has a great Saturday. If you got questions, shoot them out in the comments, and have a great weekend. Take it easy.